Despite the S&P 500 just being down a few points, panic is everywhere. We use history to help you avoid some common pitfalls. So if you were just looking at general headlines this week, you would have thought the market was melting down. The media was out to try to panic people. Social streams were lighting up with all sorts of doomsday scenarios. And yet the market, at its lowest point this week, which isn't to say it's the low point, but the lowest point this week, was down less than 5%, which just isn't that bad. Why, besides the media trying to keep your eyes glued to the TV or the newspaper, whatever they're trying to sell you, could have explained some of this panic? Well, I think it's a few different things. Number one, a lot of these novice investors chasing story stocks, whatever coin is in vogue for the day, Tesla, super sexy ETFs like ARK, been drawn down over 30%. So this is our first time getting to experience some serious volatility and have their, hey, I can do it and get rich quick schemes proven to be, once again, false, as history has shown time and time again. Second big thing is for your more traditional investors, this is the first time in quite some time they've been getting their butts kicked both by stocks to a certain extent, but more importantly, bonds. And we've been warning you about that since last summer. If you look at the ag, it's down 5%-ish over that time frame. And so again, that thing that a lot of people have looked to ballast their portfolios, it's just likely not going to be there in the same way moving forward as it has been over the last 20, 30 years. And finally, any of the general investors out there have had to have found themselves tempted by those glorious FANG stocks, Facebook, Apple, Netflix, Google, that make up the Qs, the NASDAQ, and that index, not in the ARK, Tesla type camp, but it's down 10% here from its all-time highs. So again, things that people haven't been used to of late, whether the novice investors, the traditional investors, or just the people chasing tech stories, have had to embrace some new volatility. That's the bad news. What's the good news / bad news? Well, the good news is the data looks great. So if you look at economic data, the forecast here heading into the summer shows global growth at about 7.4%, which is huge. Leading indicators continue to charge forward. Jobs look healthy, great gains in February. History would show as the layoffs slow down, then you start to get even more gains. We anticipate as the reopening happens, of course, more of that job growth continuing to cycle through. And if you look at the US consumer, they've really never been healthier, or at least not much more so. You've got personal income up over 11% year over year, savings up 21% year over year, confidence readings well above 90, household debt leverage ratios at 40-year lows, all of which sets up, when you think about still $7 billion, which hasn't been spent from the last stimulus bill, another stimulus bill of $1.5 trillion coming down the pike, to a very healthy consumer, likely a lot of consumption right as the economy opens up. Why could that be bad news? Well, again, it could be bad news if you're, again, a big tech / traditional bond investor. This growth is likely to, again, continue to lead to two things. One, rising yields, which are going to push bonds even further in decline. Again, traditional, classic, high-quality bonds. And for tech names, those rising yields, A, depress future earnings valuations, and two, open up alternatives. I think you're going to continue to see a rotation into parts of the market that are trading at much more attractive valuations that, again, have been left behind as this narrow market participation has occurred over the last couple years. At the end of the day, point number 3, last point, this is all about trying to use past performance versus past experience. Past performance and chasing past performance gets you in trouble. Learning from your past experiences helps you as an investor. How can you tell the difference about what you may be doing? To me, it boils down to a very simple question. Does the answer look more like something you wanted or something that's going to be a challenge for you? If it sounds easy, hey, I can just put my money into this stock or this crypto and get rich quick, it's probably not true. Hey, I can invest just like my granddaddy did, never have to change anything, probably not true. If it looks like, man, I might have to adjust, I might have to remain patient, I might have to be disciplined, now we're probably on to something, even though in the short term, again, it's not very fun. Second key thing about past performance versus past experience is some good news around corrections. Again, this week, just down around 5%, not all that bad. But what happens inside of us is we think, hey, that 5% is going to be the next 50. Here's the truth. Whether we're looking at 5% corrections, which happen actually with quite some frequency, turning into 10% drawdowns, the definition of a correction, 10% drops becoming 20, a bear market, or 20% drops becoming 50, crashes, a pattern holds almost across the board, which is only about 20% of the time does a 5% lead to a 10 become a 20, and a 20 become a 50. And again, if you're adding that all up, you realize the odds of a 5 becoming a 50 are extremely low. It feels like it every time, but this is again one of those moments where you got to take those feelings, hopefully remember this fact, and remember that odds are very, very strong that it's not going to deepen. But what if it does? The good news is you live through it. The bad news is we've got to go through it. But here's why we need to go through it. If we look back just over the last 20 years at cash, you're going to get about 1%. Inflation's clicking along at 2 to 3%, and in today's world, probably climbing higher, where that stock and bond portfolio, again, maybe a little bit different bonds moving forward, maybe a little bit different stocks, should be able to get you 6% plus. Yeah, it's going to be bumpy, but if this is the bear, inflation, that's chasing you through the woods, we've got to be in on something that's going to get us moving faster than that 2 to 3%. Let's call it 2 to 3 miles per hour. Cash isn't going to get it done. You may not have a bumpy ride. Hitting that pothole at 1 mile per hour may feel a little bit better, but ultimately you're losing purchasing power. You're going to be running out of money, the thing that you ultimately fear. Yeah, hitting that pothole, that pocket of volatility at 6 miles an hour versus 1 mile an hour is going to shake you a little bit more. It might feel a little bit more scary, but ultimately you're going to survive it, and it's going to help you outpace inflation and keep your purchasing power intact, which is ultimately why we're all saving and again, invoking that discipline to get to a better place over time. So to wrap it up, yeah, you need to be aware of market trends, but more importantly, you need to be aware of history. And what it'll do is slow you down just enough to understand the difference between adjusting and just doing anything. You feel the need at these times of emotions to react. It's where you're going to get into trouble. Making adjustments, that certainly might be called for, but looks and feels a lot different. We hope this helps. As always, feel free to reach out. Thanks so much.